Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to the July 25 property market update for Melbourne. And it's been incredible what's been happening in Melbourne. You know, if you watch my YouTube videos for the last 3 months, I've been telling people the market's going to recover and turn around in Melbourne, and definitely we've seen signs of this. And some suburbs have actually outperformed even my expectations. And I'm a bit of a bullish person when it comes to Melbourne. Not all suburbs in Melbourne. There's some horrible suburbs in Melbourne that are doing nothing and they're getting worse and worse in terms of capital growth potential. And I'll do a video just on those suburbs, but there's certainly some amazing suburbs that are going from strength to strength. In fact, they're experiencing extremely low volume of stock, huge demand by high income earners, and auction clearance rates are going through the roof. And it's happening even before anyone anticipated this to happen. So I'm going to unpack those suburbs and show you exactly where the hottest suburbs are in Melbourne right now. And I'm also going to talk about the long-term trends and the projections of the Melbourne property market using a lot of charts and data. So grab a coffee, grab a V drink, and welcome to today's video. Now, a bit of a disclaimer before we keep going. This is purely for educational purposes only. I'm not giving any financial advice. If you are seeking financial advice, feel free to do so from a professional that has achieved exactly the results that you want, not just someone who has letters after the name. I know because I've got many letters after my name. It doesn't really mean anything. Why should you listen to me? I've got a YouTube channel. I've also done a lot of things over the last 30 years. In the banking and financial service sector. A couple of things: I'm a real estate and a mortgage broker, ex-private banking. I've got a diploma in financial services, financial planning. The most important thing, guys, is that I'm in Melbourne. I'm a property investor, doing it myself and helping others to do it as well, which is critical because I'm keeping it real. I've got clients that I'm building wealth. I'm helping them set up their property portfolios. Many of my clients now are buying a 6th, 7th, 8th, 9th property. I'm about to do a webinar showcasing some of these amazing portfolios that we've been able to establish over the last 11 years, which is incredible. A lot of my clients are buying one property a year using my system that's outlined in this book, which is basically leapfrogging equity from one property to another. The key is you've got to choose the right property and the right suburb, and you got to get the timing right. You don't overpay for assets as well, because otherwise you'll be waiting longer for the equity to be released. Finally, the most important thing about me is that I'm actually a property investor myself with a multi-million-dollar property portfolio right here in Melbourne. So welcome to today's YouTube video. Before we keep going, I just want to thank you once again. My book's got #1, multiple now best-selling on Amazon, bestseller author, I should say. Can't speak English for some reason. So I want to thank you guys for buying my book. It was pretty quiet for the last few months, and then suddenly there was a spike last month, and I think people are getting into the market now, looking at mortgages. We've had consistent rate cuts, and I'm going to do another video just on rate cuts and what's happening in the banking and financial service sector, because that's very interesting as well. But today is purely about the market. But I just want to thank you guys for buying my book and supporting me as an author. It's always very nervous when you publish a book. You don't know if anyone's going to be buying it apart from your mum. So I want to thank you guys. And I love the testimonials that are coming through. People have paid their mortgages off. I'm getting a lot of testimonials, emails coming through from people I've never heard of and I've never worked with them, saying they bought 4 or 5 properties in Sydney and they've paid off their mortgage using my system. So I want to thank you guys for those emails. I am going to be putting those up on my Book on Finance website. So I want to thank you for sending me those emails and testimonials. I love that feedback. By the way, if you want to get a copy of my book, realestateMadeSimple.com.au for the real estate one, and the finance one, which is on how to reduce your mortgage and how to smash your mortgage in record time, and also how to set up your property portfolio correctly through trusts, jump onto bookonfinance.com.au. As a little bit of a bonus today also, if you scroll down below, there should be a link there to an online video course, which is a 2-day educational event that we recorded a few years back. That's yours absolutely free. Just for being here today, you can watch that after this video. Now, let's get into it. Let's get into the July 25 Melbourne property market update. You know, Melbourne's been pretty quiet. It's been going sideways for a long time. And I talked a lot about the economy. Melbourne was hit hardest during the COVID-19 lockdown. Then Andrews locked us down the longest out of any city in Australia. We had an exodus, by the way, pardon me. we had an excess of people leaving the state in record numbers, especially a lot of tradies and developers have left, and all different people have left. Mates of mine went to Sydney, went to Tassie to live permanently. I had people go overseas. The economy here in Victoria is decimated. We're pretty much a bankrupt state. And so the government's doing the only thing the governments can do when there's a state experiencing massive debt is taking money from the rich and the poor and the middle class through land tax grabs and things like that. So you're going to see more and more of that, especially in Victoria. We've had the land tax system pretty unfairly reviewed, where people are paying a huge amount of money for land tax, and really it's having an impact on a lot of investment strategies for a lot of people. Hasn't really impacted anything that I'm doing because my clients predominantly focus on townhouses, and townhouses, as you know, have a small land footprint. Usually townhouses are built on 100 to 250 square meters of land, not 1,000 or 800 like some of the other established homes in suburbs. But let's get into it. Let's talk about what the market's doing. And really, the market's been quiet, as I mentioned before. Now it's starting to really show some sign of life. And I'm talking about all the suburbs in Melbourne, the 400 plus suburbs. Because remember, there is no such thing as Melbourne market. Melbourne market is very fragmented. Like in Sydney now, there's 8 distinctive markets doing very different things independently of each other. But really what's happened in the last, kind of 3 months is the Melbourne market. The gap in the median price between Melbourne and Sydney is nearly $500,000, as I'll show you. And that's create a lot of pressure on the Melbourne property market. A lot of investors now are coming into Melbourne because rental yields are very strong in Melbourne. You're still getting 4.25, 4.5% in blue chip areas, which is incredible. And that allows you to keep onto blue chip properties with after negative gearing with virtually cash flow neutral status, which is very advantageous. The two things that are the most important thing when looking at buying property, guys, is not only the capital growth potential, but the rental yield potential. And the rental yield potential, usually the highest rental yield potential, is in suburbs where people have the highest disposable income. That's why income per capita is so important to watch. And this is where people get things horribly wrong. They go out to suburbs that are completely filled with broke people on minimum incomes. They buy a house or land package for $450,000, and then 5 years 5 years later, it's worth $500,000. The other areas have doubled in value. I see this all the time in Melbourne, and it's cost people a lot of money. Okay, so let's look at the holistic market in Australia. And I kind of sound like a broken record when I talk about these numbers, but I'm going to continue to talk about it as a broken record because it's so fundamental for people's understanding about the property market. The residential property market in Australia is now valued at $11.4 trillion, which is huge. That's made up of 11.3 million dwellings. There's only 2.4 trillion in debt. So it's around 22%, 21% in debt. So when you think about it as a concept, there's a lot of equity in the property market. The debt levels are extremely low, and with low gearing, there is virtually no chance of the market correcting. Yes, it can stagnate. And yes, in short term, there's going to be downturns. We've seen it all over and over. Long term, with record high migration coming in, there's virtually no chance and limited supply that the market's going to have a massive correction. Are people going to lose money on property? Absolutely. If you buy at the wrong time, with agents' commissions, with capital gains tax, with stamp duty, which is huge in Victoria, if you buy and sell at the wrong time, you can lose $50,000, $100,000. And that's why I always tell people, make sure when you're buying property, you're buying for 10 years plus. You've got to experience a whole property cycle and then make a decision whether to sell or buy. Now, if the property is a dud, you shouldn't have targeted in the first place. That's why due diligence is so imperative when you're buying real estate in Australia or in Melbourne or anywhere. So, my grandfather used to be a tailor, and he always used to say, make sure you measure something 3 times before you cut it once. And that can be taken into property due diligence and research. You've got to make sure that you do your research, because if you get the wrong suburb, you're going to be in a lot of pain with no capital growth, potentially having damage to the property created by tenants. So stay away from areas that are prone for that and do your research, guys. It's imperative. Australia valued dwellings 3 months, 1.3%. Now, by the way, this is all the dwellings in Australia combined, so I'm not sure what good this is, apart from just the pulse of the nation, I guess, because we have very different markets in different major capital cities, all virtually counter-cyclical to each other. So, and there's definitely a division of states between Australia as well. But in terms of 3 months rolling average, we're looking at 1.3% growth. So which is good because it was negative before then. 12 months, 3.3, despite the steady quality rolling annual value growth has been continued to ease with values up to 3.3 in the year to May. So remember, we're looking at May data and June because we're always looking back at data in July. The lowest annual increase since 12 months to August 23. 5-year average, 42.8% over the past 5 years, adding an equivalent approximately 250,000 to the national median dwelling value. Results may vary across regions, from 85.5 in WA to 12.8 across Melbourne. So Melbourne hasn't had its run. It's been stagnating. It's been a sleepy giant. It's about to wake up and do its thing. But once again, 5 years, 42.8%, 10 years, if you buy in a good area, your property value will double. And that's why I always emphasize, don't buy property for 2 or 3 years and expect miracles. You know, if you're out there doing it by yourself, you got to look at it long term. Yes, when I'm sourcing for clients, I'm always sourcing with the expectation and anticipation they're going to get equity out in the next, 2 or 3 years. But there's no guarantees, guys. That's the thing. 3 month changes. So once again, Australia 1.3, capital cities 1.2% growth, and combined regionals 1.6. Regionals are doing really well. In fact, Melbourne 1.2%. So you can see there, Melbourne went from negative 0.1 to from negative 1.2, then negative 0.2, 0.1. Now it's 1.2 positive. So Melbourne's definitely had a recovery. 12-month average, this is for Australian dwellings, 3.3 at the national level. Combined capitals 2.6 and regionals 5.3, which is cool. And you can see there that we had a kind of a peak in 21 in May, and then we had a decline from 21 to 23, and then an increase and then a decline, and now it's kind of coming back up. In terms of the cyclical nature, we kind of have you can kind of cluster all the major capital cities into two groups. You have Melbourne, Sydney, Brisbane, Adelaide, and they kind of function very closely to each other, and there's a delayed effect between each cycle. So Adelaide could be 2 or 3 years behind Melbourne, and Sydney usually takes off first, then Melbourne, then Brisbane, then Adelaide. This time Melbourne didn't do anything because of those economic challenges that we face as a result of COVID. So Melbourne missed out on following Sydney in the growth cycle that it would have had done. And that was a combination of lockdowns, land tax, and the various other things, and just negative consumer sentiment. So people manifest their own reality. Whatever you feed energy into grows and becomes your manifested reality. People were very negative in Victoria, to the point where a lot of people have left for the first time because they just had enough of the lockdowns, the bankruptcies, businesses going insolvent, high crime. Youth crime is off the charts, just like it was in Queensland. We've got to address that. And our Labor government is completely useless. They're not doing enough and quickly enough. Machetes now are getting finally banned, but that's going to be into October. It should have been done instantly, and these kids should be locked up as far as I'm concerned, and you should throw away the key. Because the same offenders over and over and over. But the government's doing nothing about it. And all these things add up to a negative consumer sentiment market. And then the other group of suburbs or cities, I should say, is Perth, Hobart, Darwin, ACT. And they kind of follow a synergy or a pattern between them in terms of the cyclical nature of real estate. This is very interesting because I love looking at the index when you separate the value of properties. So you have in Melbourne, you've got the 25th percentile, the 50th percentile, the 75th percentile. So the 25th percentile is the cheapest 25% of properties. Then you've got the big chunk in the middle, which usually encompasses the median price. And then you've got the 75th percentile, which is the most expensive, highest valued properties. Whenever you enter into a new growth cycle, always what happens is the mansions go first, right? Because they're paid off, and those people choose when to sell. So your Toorak, Hawthorn, Brighton, Malvern, all those areas, Kew, Balwyn, they go first. and then the middle section goes first, the 50th percentile, and then the cheaper suburbs get dragged up. Now, sometimes if the suburb is cheap enough and going through gentrification, it can take off at the same time as the mansions take off because the money's got to go somewhere and people see it as undervalued. But generally speaking, it's the top end that starts the cycle, then the middle happens because people want confirmation the market's recovered, and then the bottom worst suburbs in Melbourne, Werribee, Frankston North, get dragged up, with the rest of the market because the gap between them and the normal suburbs becomes so great. People just go, well, it's just so cheap. I remember in Frankston North was 250 grand for a house. You couldn't give them away. It was one of the worst suburbs in Melbourne. Same with Werribee and, Hoppers Crossing and Tarneet and all those areas. Well, Tarneet's actually a new house and land area. I should leave that out of the equation. But the older suburbs, and, now you look at Frankston North, it's 650,000 for an average, house. So you got to be aware of that. That's what happens, and that can be impacting your decision on which property to target at which part of the cycle and when to get equity out of those properties. The most successful investors, and it's not about buying expensive properties, guys, in Brighton and Toorak, because not many investors can buy them, number one. Number two, honestly, the numbers don't work in those suburbs. I source properties in Brighton. They don't work unless you're an owner-occupier. Brighton East works well. And I've done a lot of projects in Brighton East because you can get rental yields of 4.25, 4.5%, sometimes as low as 3.75, but depending on your tax problem. But Brighton, once you get your rental yields at 2%, the numbers just don't stack up. You're going to be costing you 1,000, 2,000, 3,000 per week, depending on the property. Most investors don't want that. They want to have the property virtually neutrally geared or cash flow neutral with negative gearing, depending on if they're buying in a trust or individual name. But that's very important. So Melbourne has truly recovered now, and now it's going to the next stage of the growth cycle. And I think it's going to be a super cycle. I think it's going to go crazy. In that period of time, this is why you look at a 5-year period. This is June 25. Bowen North, for example, even though last year to year went at negative 5.3, over 5 years, went up by 26.4% in terms of median price. Surrey Hills, 26.3%. Eaglemont, 24.5. So you have the eastern suburbs. Then you got Hampton, which is Bayside, 24.4. Blackrock, 23.8. Hawthorn East, back to the east, 22.6. Camberwell, 22.5. Bowen, 21.6. Hawthorn, 18.3. And Malvern, 17.7. So just because Melbourne was negative 1.2%, don't think that every suburb is negative. And I've sourced properties in Eaglemont, in Blackrock, in Hawthorn, in Bowen North, in even surrounding suburbs like Ashburton, Ashwood, all those areas. Even within the suburb, you have school zones, you've got parks, and you have streets that are better than others. You might have a street in Bowen North where you're facing a petrol station and the house will be devalued and there'll be no value in that property compared to a property that's in one of the school zone catchment areas opposite a park in a quiet court. You know what I mean? So even within the same suburb, the variance of capital growth could be 6% for the worst street PER and 8-9% for the best street PER. Do you know what I mean? So the variance is huge even within the suburb. Not even across different suburbs, but within the suburbs that are good streets and bad streets and average streets. So, it's about sourcing and focusing on the fundamentals. And remember, as investors, we're always looking at the micro level scenario. You can't invest in the index. There's no Melbourne property market index. Ultimately, you're going to have to go into a suburb and choose a specific property in that suburb. So I'm always focused on micro level due diligence, not macro. Macro is important just for psychology and the big picture, but it's all about micro level. Housing cycles, you can see there you've got the 28-day rolling average, which is kind of the pulse of the market. I don't want to focus on it too much because it's still kind of clustering all the major capital cities together. You can see that Sydney has gone, this is for May, which is the latest data, 0.5% for May, for the quarter 1.1%, for the year 1.1%. You can see it's going down into a downward trend, which is interesting. Melbourne now has recovered, as you can see there, 0.4% for May, 1.2% for the quarter, negative 1.2 for the year. But it's going down. It's turned the bottom and now it's coming up. And now it's going to go into a growth trend. It could go into a W pattern. We don't know, but it's definitely with the rate cuts that are coming. And I'll do another YouTube video just on rate cuts. I think there's going to be a huge upward trend in Melbourne, and it's going to get very close, if not take Sydney out, and the median price will go up by $200,000 or $300,000 very quickly. Brisbane's in a downward trend. So if you're an investor that's targeting property cycles, Sydney and Brisbane are down now. They're going down in terms of the property cycle, and Melbourne is now recovering. Adelaide, no one cares. Perth, down as well. And Hobart's going sideways. Hobart had a big run during the COVID-19 lockdown. Hobart's a beautiful city. And people just moved there for lifestyle. They got away from Melbourne and the lockdowns. So there was a bit of a inflated boom in Hobart that occurred just because of, COVID-19. And now it's going back to its normal pattern of behavior, so to speak, because we haven't got any viruses. We haven't got anything that's coming up, that's going to alter that market. Darwin's going sideways now. Very volatile on the back of the commodity sector and the currency sector, so it's very much linked to the mining sector. Canberra, sideways, and that's it. Sales and listings. So the volume now, which is interesting, there's some suburbs in Melbourne, they're oversupplied. A lot of house and land estates in Melbourne, owner developers that are holding onto hundreds and hundreds of blocks of land they want to sell tomorrow, but they can't release them all at once, so they stage release them 10 at a time. Remember, if you've got an estate, let's say in Wallen Wollert, and there's going to be 200 stages over the next 10 years, you're not going to just release 2,000 houses in Wallen Wollert, right? Which is north of Melbourne, about 50 k's. I don't know why people live there. But anyway, you're not going to release all of them at the same time. You're going to stage release them, and then as they sell, you're going to release the next stage slightly higher than the previous stage, right? It's development controlled stage release subdivisions. So those ones are oversupplied. And just because there isn't any listings doesn't mean that the market's not oversupplied, because they can release the stock tomorrow. But if you look at a normal suburb, like my office is in St Kilda, for example, there's just no stock on the market, guys. There's nothing. And people are just not listing. Volume of sales in some suburbs and listings, which are linked to sales, obviously, because if you don't list it, it doesn't sell, are down 30 and 40% from the normal volume that should be selling. So we're seeing a massive below 5-year average of volume of listings and sales across the board. This is happening in Sydney as well, in Brisbane, in the best suburbs. Or it's not so much just the best suburbs, I should say the older established suburbs, at least 50 to 100 years old, where you can't create new subdivisions. It's all built up and you've got to deal with individual properties. That's where it's happening. In terms of median days on the market, you can see there, May 25, Melbourne, the average house sold in 36 days, and then May 24, 34 days. So 36, 34 days is pretty fine. That's a good, strong market. Once you get to kind of 50 days, 60, that's a very slow market. And once you get to 15, 20, that's a crazy market. That means everything's selling. So it's a steady market. Like auction clear rates are 76% at the moment. So, 30 days, no problem for Melbourne. Vendor discounting, you can see that Melbourne, negative 3.3 and negative 3 for 24 and 25. That's pretty low. So vendors are still getting, the market's meeting their expectations, if you like, and they are getting what they want from the properties. Remember, vendors are always unrealistic. They always want 100 grand more for whatever they have. And also agents feed into that, because to get the listings, a lot of agents will promise exorbitant prices, with a disclaimer, obviously. And I'm not having a go at agents. Many of my best friends are agents, so it's all cool. But, people are greedy when they list, and the agent that will promises the highest price usually gets the listing. But, 3.3% vendor discounting and 3% for Melbourne, I mean, that's very minimum. So we're talking about a small discount to get the property sold at auction when it's passed in, or, private treaty, depending on what you're looking at. Listings are down though, 7%, same time last year. So they are record low. The reason is because there's not much new stock coming onto the market, and there's been 7,000 bankruptcies and insolvencies in Australia in the development building arena. Many of these companies are not coming back, and there were some of the biggest builders in Australia went down, with hundreds of people working for them, and then also they took down a lot of other building companies with them and trades. So the industry's been decimated to a large extent, and the Labor government didn't do anything about it. Just sat back and watched it, spending $500 million on the Yes campaign. Anyway, don't get me started on Labor. Listings are going sideways. They are down 2.1% for the previous year, 13.2% negative for the previous 5 years. It's going to take us, I think, and I have no data, I'm just completely guesstimating this based on my experience. It's going to take us 20 years, 2 generations, to replenish the developers and builders that we've lost as a result of COVID and the bankruptcies. A lot of these developers and builders, when they go bankrupt, they will never go back to the industry. They've lost their houses, their marriages. There's been, this is not something easy to go through when you lose a company. So it's going to be a hard and slow recovery. And on the back of this, we have record high immigration coming into the country, and that's why property prices are going up. So listings in Australia are -7%. Which is quite interesting. For the 4 weeks of 1st of June, freshly advertised stock levels across the capital cities and the rest state regionals were down almost universally compared to the same time last year, with the exception of regional Northern Territory, where new listings were 20% higher. Total listings were more diverse, with 6 markets led by Perth, plus 9.2%, seeing stock levels accumulate relative to 24. The remaining 9, led by Darwin, -35.4, were down. So you can see that it's all negative. Negative because we can't create the stock, number one. Number two, all the major capital cities are going into a downward trend, so people can't upgrade houses because they can't get the price they want. Because remember, 78% of the market is owner-occupied. People living in houses. And if you sell a house, you don't go homeless. You've got to upgrade or buy something else. And if you can't get the price you want for your house, or there isn't much incentive to upgrade, you're just going to sit put on what you have. Melbourne still hasn't got strong enough signals for the general market to understand, the general public, that it's going into a recovery phase. Only investors are aware of it, and that's why investor activity is record high. Auction clear rates are kind of hovering in Melbourne around the 75% mark, which is really healthy. Out of 10 houses, 7.5 are getting sold. And that's a really good result for Melbourne, considering where we were and where we came from. We had auction clear rates as low as 55%. So it's really strong, and that's on the back of the combination of low stock, low listings, and high demand built up by people coming into Melbourne from overseas. The rental market's been a disaster for people trying to get into the market in Melbourne. I'm hearing horror stories where people have literally, and these are not homeless people. These are like high income earners are getting displaced and they can't get it back into the market. I heard a story the other day. There was an ambulance worker and she basically was renting an inner city townhouse. The vendors moved back into the townhouse. She got evicted. She couldn't find the property. She applied 40 times, got rejected every time because it was other tenants. And now she's literally sleeping in her car and taking showers in the hospital she works in. And this is an ambulance worker, which is crazy. So there's a lot of high income earners, teachers, and for the other stories where literally they were renting, they get displaced for some reason, usually because the vendors come back or they're trying to sell the property. And this has happened with investors selling properties because of land tax as well. And they want to sell the property, do a renovation to add value and sell it without a tenant because they sell a little bit better, potentially, in some instances, depending on the property. And those people can't get back into the rental market. So the rental market's been a disaster for tenants. It's been a blessing for landlords because I have seen suburbs like Carnegie, like Hawthorne, Baldwin North, Surrey Hills, Elwood, where rentals have gone up by 10-15% for the last 3 years every year on the back of 3% in inflation. So I mean, these guys are laughing all the way to the bank. We did a three-bedroom townhouse in Carnegie a few years ago that settled. Rents were $850 a week. Then they went up to $950 a week. Now they're renting for $1,200 a week within 4 years. It's crazy. I mean, they used to take nearly 10 years to happen. And this is Carnegie. We're not talking Toorak Hawthorne. We're talking Carnegie, which is a really cool upper middle class suburb in Melbourne. So, there's stories like that. So when you're buying a property, as an investor, you've got to be aware of cash flow and the importance of cash flow. But not only cash flow at the time you're buying the property, you've got to be aware of where you are in the property cycle of the cash flow property cycle, because cash flow cycles and growth cycles are out of sync with each other. So what I mean by that is usually when you have the growth cycle of a suburb, the actual rental cycle is around 2 or 3 years delayed, because leases are usually fixed for 12 months at a time. And so what happens is you might look at a property in the suburb and the rental yield could be 2.5, and you go, well, that's a low rental yield, not realizing it's about to boom. And if you buy the property within 3 years, your rental is going to be 6% on the price that you paid originally. So just be aware of property cycles and rental yield cycles are two different things, and they're not in sync with each other. They're out of sync, and they're out of sync by years, depending on the suburb and the dynamics of the suburb. A lot of people are not aware of this, and this would cost you a lot of money. So at the time that you're buying the property, the rental yield is not that important. It's the rental yield over the last 10 years and where it is in the cycle. Is it peaking? Is it in the middle? Is it going sideways? Is it going to a decline growth? I've seen suburbs like Richmond where there was just an oversupply of stock one year. There's a lot of houses, literally hundreds of houses, townhouses that settled over a number of estates, and the rentals plummeted by about $100. And agents couldn't believe it because there was just so much stock on the market that year. And it was just purely coincidental that all these projects settled at the same time. And then the following year, everything recovered and got absorbed. And this happens sometimes in the best of suburbs. So you just got to be aware of the number of stock you're competing with and what's happening with rental yields in the property market. Rental yields, you can see that they peaked in 21 and they kind of went down. But, annual change of 10% is crazy. Like 10% increases is crazy. Regional growth continued moderately in May. National dwellings rent went up 0.4% over the month, which is still pretty healthy, taking a 12-month trend to 3.4, less than half of the 8.1 annual rise recorded the last year. Melbourne 1.5, Sydney 1.8, so the same sharp slowdowns annual rental growth compared to last year. Both markets now recording yearly increases below the pre-COVID decade average. During COVID, I was selling a lot of townhouses in the Bayside in Melbourne where you could have walked to the beach because we had this restriction where you had to live within 5Ks a radius. You couldn't go beyond that radius. If your townhouse was within 5K of the beach, at least when you're exercising, which is once a day, you could go to the beach once a day and exercise. So the rents for those townhouses went up by 30% in 2 years. 30%, which is crazy. Which is unprecedented. But I had a feeling it was going to go way above market because if you're in lockdown and you can't work and you can get to water and the beach every day, like you would do that. You would drive and go there for a run, for a walk, because gyms will close as well. And there are places on the Bayside where they have gym equipment outside that's built in for the public to use. Very basic, but it's there. So a lot of people that were into health and fitness paid a premium for townhouses that were actually close to water. And I capitalize on that. That's why I'm pushing the Bayside. So, which is where the money is in Melbourne anyway. So rental yields now are stabilizing, 3.7 for Australia, capital cities 3.5, and regionals 4.4. For Melbourne, the best suburb was getting 4.25, 4.5. Long-term increases far beyond inflation. Inflation is tracking at 3%. Rental yields in the best suburbs can go up by 3%, 4% above inflation, which is really cool. Building approvals are below average because builders have disappeared. It's harder to get finance. Serviceability has been an issue. Now there is a little bit of an increase because interest rates are coming down. Still, serviceability is an issue with first home buyers, and that's why the government is creating first home buyer incentives, but it still hasn't had that desired impact on the market. First home buyers are still relatively low, especially in Melbourne. Prices have escalated. It's literally everything's $1 million. There's nothing you can get under $1 million that's worth buying. And a lot of young people are turning into rent investing. They're renting where they want to live and they're investing to make money. And that's a really good strategy. If you can't afford to own the property in your desired suburb, rent there and then buy growth assets in other areas you would never consider living in just to make money. And eventually you can buy your dream home. That is the best option to do rather than living in a shit area and fighting traffic all day long and losing your mind, which is what some of the western suburbs, or or being stuck on the train for an hour, or coming home and there's nothing in your suburb. I mean, why would you do that? Like, there's no point living out there. The house is going to be worth nothing anyway. They're going to be the slums of tomorrow. My advice is to live where you want to live, whatever you're into, whether it's the city or the mountains or the beach, whatever you're into, and then buy whatever you can afford to buy in the best possible suburb. I wouldn't just buy something because I want a 4-bedroom house and that's it. I'm just going to not settle, and I'm going to be 100 k's from the city, surrounded by cow paddocks and just one petrol station and McDonald's. I mean, there's probably better options than that, but that's me. I don't know. What do I know, right? So finance and lending, I'm going to do another video on finance and lending because it's really complex and the generalizations are dangerous when it comes to this, because you've got to go deep into what people are doing, what kind of loans they're taking out. Couple of things I want to highlight. Investment lending in the last 2 months in Melbourne has skyrocketed. A lot of investors are refinancing multiple properties. They're setting up lines of credit, equity withdrawals, because this takes months. To get an equity withdrawal, by the way, it takes 4 or 5 weeks. Like, banks are super slow. There's forms, even if you're doing a top-up facility with the same lender, getting a valuer out and then getting your financials up to date, unless the LVR is below 80%, but if it's above 80%, getting financials and all that stuff, we're talking weeks. It's always weeks. Finance is always slow. Whatever you think is going to happen in finance, double it and add 10%. Okay, then you're not going to get close to what's happening. But activity is up 30-40%. So investors are preparing to get into Melbourne property market because they understand the backyard, and also people from Sydney and Brisbane are coming in hard into Melbourne because they know that Melbourne is 30-40% cheaper than Sydney and 20% cheaper than Brisbane. So they're going in hard and they're buying up properties and starting to move as well. So investment lending definitely is looking very healthy at the national level. Total investment lending percentage 37.9%, and you can see there Melbourne is very strong. Victoria, I should say, 31.2%. But New South Wales 42.9, Queensland 38.8. They're all coming in and they're going to be snapping up in their own major capital city, and a lot of them are going to do interstate investing. I've got a lot of clients coming in from interstate, buying properties. So you can see that first home buyers were quite strong in kind of 20 and 21, and then they kind of went down. And now they're still active, but not as much as the government would like them to be. Serviceability is the main thing. Interest rates are super, super exciting because, as you can see there, between May 22, we've had 13 interest rate rises from 0.1% bank swap rate to 4.35. And that was unprecedented. I mean, that was just something we have never seen before. It caught a lot of people off guard. Just so you know, and I'm just telling you to annoy you and to rub salt into your wounds. If you went to my live event in 21 and 22, Stephen and I were talking about this is the best time to fix your rates for 5, 7, and 10 years. Do you know you can get fixed rates in Australia for 10 years? Yes, you can get fixed rates for 10 years. Ring up your private banker at NAB CBA. 5 years is easy. That's off the shelf. But you can get a quote from the bank for 7 years and even 10 years. People fixing rates when the bank swap rate went to 0.1, and I said to people, it's never going to go to zero in Australia, no chance. I won't go into why because it's a whole discussion, but it's never going to go to zero. This is the time to fix if you want to fix, or at least fix properties that you're known to touch for the next 5 to 10 years. And a lot of low income earners that just got into their property, or they had 3 or 4 properties and they started to get a bit concerned, fixed everything or fixed a big part of their portfolio. And let me tell you the feedback I've been getting. I mean, I've been getting alcohol, champagne, cognac sent to my office, hampers, because I've saved them tens of thousands of dollars. I mean, imagine you fixed for 10 years at 3.54%, and then now it's like, 6.57. I mean, multiple properties, forget about it. Now, I'm not a big fan of fixing rates. I'm a big fan of variable rates because 80% of people that have variable rates outperform people that fix rates. But back then, if you were lucky enough to attend a live event with me and Stephen McClutchy, we'll say to people, guys, this is the moment you want to fix everything as much as you can, providing you don't fix to the point where it stops you from buying more properties. Okay. So there's no point fixing everything for 10 years if you're not going to buy another property. But if you're maxed out completely, let's say you got 5 properties and you're maxed out, yeah, I would fix 4 of them, and leave the one with the greatest potential for capital growth to make sure you get the equity to buy more. And that's what people did. Now we're in a downward trend. And remember, when the trend reverses, it's going to be pretty aggressive as well. We're not going to see 1 or 2 rate cuts. We're going to see multiple rate cuts. I think we're going to have rate cuts of 1.5% down. And I think the will stop around mid 26. So I think the bank swap rate will go down to 3.15, even 2.95. No one's got a crystal ball, but I can feel that inflation's low, employment's strong. I can't see any kind of danger of cutting rates by the RBA. And I think they're going to be cutting rates multiple times, 25 basis points each time. So for those who bought properties in 21, 22, they're going to be cash flow positive very quickly. Even without negative gearing, some of them will be close to neutral or positive. But with negative gearing, a lot of them will be cash flow positive completely, which is incredible. Can you imagine 21, 22, you bought a property in Elwood for $1.5 million, and now it's cash flow positive. After all expenses, it's paying you money. And this is the thing. The discipline of building wealth, guys, isn't timing the market. It's timing the market. It's focusing on the fundamentals, choosing the right property, the right structure, making sure you don't overpay, and then having a strategy all encompassing and moving forwards. And the ones that do that, they win. The ones that try to time the market, I have never seen one investor that has successfully timed the market over an extended long period of time, like 10 or 15 years. Yeah, sometimes you can get it. I'm telling you now, it's the bottom, but long term, it's more of a gambling approach than a psychology of investing. But definitely we're going down, so this is a good time to have everything variable, and we're nowhere near the bottom of the interest rate market. So keep all those loans variable now, and set up your lines of credit and equity releases. You can see the housing credit, it's just stagnating, going sideways. Nothing interesting about that. It's very fragmented across different major capital cities, and also it's suburb fragmented, and there's a lot of disparity between suburbs and income demographics per suburb. Suburbs where people have very high disposable income are showing the highest amounts of refinancing and getting equity release. And that equity is not only used to buy properties, guys. People use equity to buy cryptocurrency, shares, businesses, commercial property, anything you want, upgrading their property, or you can use it for consumable like cars, holidays, whatever you want. So there's definitely, a lot of good stuff there. So that's pretty much the market. I won't go into convergence because it's quite boring and has no relative meaning in anything apart from macro level analysis. Big picture stuff, guys. I'm a big picture person. I always look at long-term fundamentals. And I think if you stick to the fundamentals, you're not going to make the wrong decisions in the short term based on micro level fluctuations, which is the media and the doom and gloomers. And this is the thing, you always got to go back to the fundamentals. Average homes in Australia may cost 6.3 million in 20 years. A bombshell study has revealed. Projections show the median prices will reach the figure in Sydney by 2043, up now from 1 million and 30. Well, now it's actually worth 1.5. Aussie Home Loans CoreLogic survey predicts the average price will hit 5.8 million in Melbourne, 2.9 million in Canberra, 2.5 in Perth, 2.3 in Brisbane. Highest increase in Melbourne. Melbourne is going to be the biggest capital city in Australia by population, 37 million people, and it's going to be one of the most expensive. We'll never catch up to Sydney because Sydney has more expensive houses because they have those beautiful, hills overlooking the ocean and the whole North Shore and all the little beaches they have, Double Bay and Vaucluse and all those amazing Rose Bay, all that kind of stuff. We don't have that in Melbourne. Melbourne's very flat. Good for cycling. Okay, the city is very hilly, and they've got a lot of amazing water views. So because of that, there's a lot of suburbs overlooking water, and they command a premium. So Sydney is going to be 6.3 by 43. So this is like 18 years from now. Melbourne 5.8 million from 1 million. Now this might not happen. It could overshoot, undershoot, but let's say it's 5 million, and the median price is 1 million today. I mean, what are you going to do to make sure you're part of this? We're looking at Bitcoin now, equivalent of $10,000, and it's now 160 Aussie dollars. Like, how many Bitcoins did you buy at 10,000? Do you know people saying at Bitcoin 10,000, oh, it's so expensive, it's going to crash. And now it's going to 160, and I'll tell you it's going to go to a million. And people will say, oh, no, it can't possibly, it's too expensive. And it's going to be one of those things, I wish I bought it at $1,000. Well, Melbourne is at the bottom, guys. This is it. I'm calling it. Melbourne is at the absolute bottom of the market. This is the median price of all houses since 1880 in Australia. You can see that Melbourne's one of the most important cities. Sydney is probably the most important city. Glen Waverley houses were $5,000, I should say, $200 holding deposit for land in Glen Waverley. What are the houses selling now for? 3.5? One bedroom house, brick veneer, built in Glen Waverley, 1960s, £3,375 on your land. The old brick veneer. I hate those houses. You can't do anything with them. You can't renovate them. They're just the most useless design, right? But they're everywhere. Bentley, Moorabbin, all the older suburbs from the 60s have them. And they're just the nasty design, nasty. Love Victorian, love Edwardian, love Art Deco, but the 60s just horrible. Imagine this, all right? This is for the petrol heads out there, which is myself and all the X-Gen people. XB Falcon, 6,990. This is brand new. Can you imagine? XC Falcon, 7,290. X78 XC, 8,290. And the Special Falcon, my God, 699. They're 100 grand now in average condition, 130. If they're Mickey Mouse, 150, 200. Can you imagine going back there and just buying a bunch of them and bubble wrapping them in your garage, or putting into a storage facility somewhere and just now opening it up? I mean, it's crazy. Some of the GT ones are selling for 250, 300, maybe 400,000 if they're rare enough. The AC Cobras were selling for how much? 250, 300. And they were just so affordable. And what a beautiful, stunning shape. I think they're better than Mustang Mach 1s. Personally, they're just harder for parts. But I mean, this is the thing, guys. This is like, we're now looking at, XB Falcons for 7 grand. You got the opportunity to buy Melbourne at the same level. So this is the bottom of the market. This is where Melbourne is right now. We've been there before. We've just hit the bottom. We've bounced from the bottom. All the fundamentals are lining up in the same direction. I don't know when the peak will be. We could have a W pattern, but it's definitely going up, and there's no sign of slowing down. And the gap between Melbourne and Sydney is $500,000, which is, last time that happened as a percentage was 2001, and Melbourne went up by 20, 30% for like literally 2.5 years in a row, and then it slowed down. So you've got an opportunity for properties to go from 1 million to 1.5 in good suburbs. Even the worst suburbs that are going through gentrification, Sunshine, Heidelberg Heights, West, Belfield, places like that, they're going to go up by, $200,000-$300,000. There's so much money there. What are you going to do about it? Are you going to get ready? Are you going to get financially pre-approved? Are you going to do those taxes that maybe you've left for years? I mean, this is the time to do it. Whatever you need to do, this is going to be an opportunity, because once properties get to 1.52 million median price, and remember, wages are stagnating even below inflation. This could be for some people, especially those people that are on 100 grand, 110, the final opportunity to ever get into the Melbourne property market for a townhouse or a detached house. And after that, it's going to be like Sydney. It's going to be a dream. It's going to be something that could never happen again. You're going to be locked out of the property market indefinitely. And so here we are. So for those who want to time the market, and once again, I'm not a fan of timing the market, but if you are, this is it. This is the bottom. We've just bounced from the bottom. In fact, the bottom was probably, I would say, April, May. and we're going up. So for those who are interested, definitely take action, guys. This is it. So if you're interested in learning more, I hope you enjoy the market summary. A couple of things we're doing is we're doing live events in my office in St Kilda. So if you want to join us for a 2-day event, which is pretty much on finance, structuring, and property selection methodology. There's Cameron Fisher from Changing Places Real Estate, 45 years in the real estate industry. He's a valuer as well. Stephen McClutchy from Loans Australia, settled over $1 billion, 30 years in lending. And myself, we're speaking there for 2 days, talking about the property market, the latest strategies, case studies. It's going to be amazing. I'm going to tell you exactly where to invest, where to stay away from, like a P. Diddy after night party. So if you're interested in that, tickets are selling at $47 per ticket, and you get a hard copy of my book, which is kind of like the manual for the 2 days of real estate investing made simple. And we throw in lunch on 2 days as well. So tea and coffee and lunch is provided. I don't make any money out of these events, by the way. Like, I don't make, it's just to break even for the event, just so you know. That 47 just covers cleaning and the books and the food. It's there just to, I just want to give back and educate people. And some of you will end up our clients, some will never do anything with us, and we're really cool with that. But these events are not money making exercises. I could be charging hundreds and thousands of dollars, not hundreds of thousands, but $1,000 or $2,000 for these tickets. And with that incredible feedback, we don't hold anything back. We tell you exactly what our clients are doing, how they're structuring themselves, how they're buying properties through trusts, how they're maxing out, how they're going beyond what they could buy. I'm going to show you how you can scale up pretty much indefinitely through trusts. And Steve and I do that section. People get blown away. Mortgage reduction programs, even if you never invest in property, just to learn how you can smash your mortgage from 30 years down to 10 and save hundreds of thousands of dollars of potential interest rate payments you'll give into the bank. Just for that one system, it's worth turning up to the event. So I hope to see you there, guys, and I hope to meet you in person. Also, if you want to work with me one-on-one, I am getting nearly at capacity now, and there's not many places left. And I will be hiring more people in the future because I'm so busy with existing clients. I've got so many active clients now that are buying multiple properties. So I'm nearly at that point, guys, where I'll stop taking on new clients. And I have a few people that are going to be working with me in the same capacity at Investors Prime Real Estate and looking after new clients. So this could be one of the final opportunities if you want to work with me one-on-one as your coach, as your mentor. Definitely organize a 60-minute free Zoom strategy session with myself. We can develop an idea into a plan and to an action plan. So this is where I take you from where you are and where you want to be, and I'll show you how to get from A to B with the least amount of effort, maximum results. There's an old saying, if you fail to plan, you plan to fail. I help you develop a plan, and this is a real plan of what you need to do, what properties to target, what structure to buy them in. You can walk away with a real sense of clarity from these meetings. A lot of people waste so much time by doing the wrong things, and they look back and they've done nothing over 10 years. And remember, you can always get more money, but you can't get more time. Time is a resource that's always finite and running out. And your decisions or indecisions have the same consequences, guys. If you've sat on your hands the last 10 years, Melbourne median price was $600,000 10 years ago. Do you know what I mean? You could have jumped in any suburb without any due diligence like that. You would have doubled your money by now. So if you have the ability financially to buy a property and you have a good credit score and you've got a bit of equity in your home, come and see me. I'll show you exactly how to unlock that dead money in your floorboards and start getting that money to work for you while you sleep. Most of my clients now that have been with me for 11 years, that have bought 5-6 properties, they are making more from capital growth of their portfolio than they are from their job income. That is crazy. So they make more money while they sleep compared to their active job, which is where you want to be. So by all means, it's an hour strategy session on Zoom. It's free. There's no strings attached. Just a couple of qualifying criteria. I'll give you a whole team as well. If you need a good accountant, good lawyer, good mortgage broker, mortgage specialist, quantity surveyor, insurance broker, property manager, law, every single person that is needed in your team, I'll share those details with you. And a lot of them I use myself, like Brad Beer from BMT, who's a quantity surveyor who's wrote a chapter in my book on depreciation. I use BMT quantity surveyors myself for my properties. So you get priority access to the whole team. I'll talk about the properties that I can source for you. So at least you walk away with clarity and the whole team and the strategy. And step by step by numbers, guys. It's you can't go wrong. How do you qualify? Well, the cheapest properties that I source in Melbourne are $700,000. So you need to have at least $700,000 purchasing ability. If it's less than that, I can't help you. There's nothing that anyone can build in the suburbs that I source below 700. The average townhouse that I source is 1.2, 1.1, and the good one is around 1.5. But below 700, there's just no margin anymore to build. Even in Hoppers Crossing, Werribee, you can't build for 700,000 anymore. And I'm not going to go, 200Ks from the city somewhere in the middle of nowhere. So as a single borrower, you need about 95,000 income and about 112,000 in equity or savings, or just go to a bank and get a pre-approval. I'm just telling you the fundamentals. There's a couple 120, 140 combined income and around 112, 126,000 in accessible equity or savings. So if you qualify, feel free to drop me an email, Konrad at investorsprime.com.au, and we can organise a time to catch up and go through your situation. I can share with you all my wealth and how I can add value to you and develop a strategy. That's it for me, guys. Thank you very much. I hope you enjoy the update. I hope you take action. It's a very exciting time in the market. I can just sense in my bones things are moving. And talking to a lot of sophisticated investors, they agree the market's about to boom in Melbourne. And now it's up to you. This is Konrad Bobilak, and I'll see you on the inside.